Hey there, everyone. Welcome to the Final Bar. It's Tuesday, March 26th. Thanks so much for joining us every weekday after the close as we break down this market environment. Pleasure to join you here from a somewhat cloudy Redmond, Washington, and an interesting way of thinking about the markets, the cloud cover. While overall the market trends remain quite strong, I think one of the things you'll notice on a day like today is the sell-off going into the close. And that's actually been a situation with many days here in the last week, really since last Wednesday, which was the second day of the Fed meeting where we had Powell's press conference, latest update on Fed policy. Thursday and Friday, really, we gapped higher Thursday morning, then it was kind of a slow grind lower from yesterday's session with a bit of choppiness going into the close today, really rolling over going into the close. That caused the S&P and the NASDAQ, even the Dow, to finish in the red. You're seeing some of those late-stage sell-offs, and what's concerning about that from a high-level sort of market participation perspective is that's where a lot of the big institutions are moving their shares. They don't tend to do as much trading during the day. There's sort of that big acceleration of institutional volume into the close. That has been selling pressure more than buying pressure if you look at the action in the markets. With that said, though, the market trends, I would argue, still very much positive. We're in a primary uptrend. We're making higher highs and higher lows. Let's look at the charts today and see how they played in around those trends that we've been observing here for quite some time. Before we get to the charts, do want to point out a social media poll we had thrown around over the last 24 hours. The question was, is your allocation to equities higher or lower than 6 months ago? 61% of you said higher, only 39% of you said lower. It's interesting, I actually didn't give you an option to say no change, just because I was hoping to get everyone to sort of vote one way or the other. I really haven't changed my allocation much in the last 6 months, to be honest with you. I've stayed relatively stable with it, but it's interesting to see that many of us watching the show here have been leaning into a risk or leaning into equities. The reality is that's where the returns have been. One of the 3 and 3 charts as a teaser is going to show you why stocks still represent a pretty decent place to be. Even if you're in the sort of correction, pullback, sell-off camp, you have to remember that the long-term trend has very much been stocks over other asset classes. As one of my guests last week, I think that was Chris Ferrone, talking about soft assets like stocks over hard assets like precious metals. Still remains the case here. Let's get to the charts and see how things played out on the charts today. The S&P 500, the NASDAQ composite, even the Dow after the sell-off into the close finished into the red. Not by much, though, let's be clear. The NASDAQ composite was down about 0.4%, just above 16,300. The S&P 500 closing just above 5,200, and that's down just over 0.25% from Monday's close. Mid caps and small caps both down by a slight amount, we'll call it 0.1 to 0.2%. The small cap ETF, the S&P 600, was down the least, but still, let's be clear, all about the same, down slightly from Monday's close. The VIX pushing a little bit to the upside, but still very low, right? At 13 and a quarter, what we'd say a 13 handle is very much low volatility, right? The VIX in the low teens is low volatility. And what does that really mean to you? Volatility is a measure of movement, right, from one day to the next. And the VIX is looking at what's called implied volatility. It's actually looking at the options market for the S&P 500 index and seeing what sort of volatility there is there, with the idea that the volatility in the options market, the movement in options pricing, is an implication or implies volatility of the underlying index, in this case the S&P. The VIX remains fairly low at around 13 and a quarter, and what that tells you is there's just not a lot of volatility, because volatility is usually not bullish, right? When we get sort of calm and we're slowly accumulating shares, volatility is relatively low, which is what we've observed through much of 2024. A spike in the VIX would probably be a negative sign for stocks. VIX 15 is where I have my alert set up. We did not get that today. We're still around 13 and a quarter. You can see that interest rates moved slightly lower today. The 10-year yield was down, finished today around 4.23. The 5-year yield around 4.23, so that's 4.23%. And the long bond yield around 4.4%. The short end of the curve, of course, still remains relatively high. So we do have that inverted yield curve. Now, we'll talk to my guest today, Mary Ellen McGonagle, about a number of things. And one particular sector, by the way, that's showing continued signs of strength, I would 100% agree with. I think where Mary Ellen is going to go with those thoughts. But we'll also talk about the Fed and the interest rate environment. And to be honest, the two ways that a yield curve can uninvert, which tends to be more of a healthy yield curve and speak to economic growth and prospects for economic growth, is the short end comes down and or the long end goes up. You're actually seeing the long end come down. The Fed starts lowering rates later this year, which seems likely starting at the June meeting. You'll see that short end come down below 5%, maybe much further, in which case we start to get more of a normalized yield curve. A long way to go between now and then. Dollar index, no real change from Monday's close, slightly higher from there. Looking at the commodity space, most of these actually in the red, although gold did finish slightly higher. The GLD was up 0.3%, silver prices 1% lower. Copper, crude oil, all the other commodities in the red slightly today. So generally speaking, energy sector, encouraging signs, but then stalls out here. Crude oil did get above $80 a barrel, which was sort of our basic threshold. That was our level to say, all right, makes sense to look at energy if we can get above that point. I'm seeing a lot of energy names that have had some interesting improvement, but today you're actually seeing a bit of a retracement from that recent move. Energy was the worst performing sector. Actually second to the worst after utilities, which is at the bottom. Cryptocurrencies remain a very choppy environment. Bitcoin is really revolving around that 70,000 level. Just over the last day, right, going into Monday's equity session, you saw that Bitcoin was down in the 65 to 67,000 range, had a nice spike higher on yesterday's session, getting back above 70,000. Today, we're sort of toying with that level yet again. I would say the long-term chart of Bitcoin still appears quite constructive. You can see higher highs and higher lows. I would say that still persist. However, we're stalling out on numerous attempts to get above 70,000. That might be one of those big round number plays that we've talked about often with cryptocurrencies. Looking at the 11 S&P sectors, you see healthcare number 1, financials number 2, both up about 1/3% from Monday's close. Consumer discretionary number 3. And after consumer staples, the other 7 sectors were all in the red today. So more weaker than stronger looking at the sector level. You see utilities were down 1.1%. Energy and real estate round out the bottom 3 at the bottom of the list. Those biggest market cap weighted sectors, things like technology, communication services, were slightly lower. And that really rolled over going into the close. Both those sectors closed at the lows of the day, and that's what's providing that downside momentum going into the close for the major averages. Looking at what we call the Magnificent Seven and Friends, these are some key mega cap growth names. Tesla up about 3%. Everything else sort of flat to down. You can see at the bottom of the list, NVIDIA, which is in the semiconductor space, obviously one of the bellwether groups within technology and arguably for the markets as a whole. NVIDIA down about 2.6% today. Meta, Amazon, all down as well. Let's go to a daily chart of the S&P 500, see how things played out through the course of the session today. I was on vacation yesterday, had my brother and his family in town. They are traveling back to Cleveland, Ohio as we speak. So good to show them around the Seattle area. And thanks for allowing me to have a little break with some family time, which was awesome. But as I'm resetting this morning, sort of taking a fresh look with fresh eyes at this market, which is always a good exercise to do. I mean, I'm encouraged by the fact that prices are still going up. I'm less than encouraged by the fact that we're seeing all the red flags I remember thinking about before being off on Monday still here, right? Still sort of alive and well. The S&P closing at the lows of the day did take us back below this trend line. I mean, less and less is this trend line a perfect measurement of the trend. I mean, there are times when trend lines like this just play beautifully with the overall trend in the market, and I find that they're really valuable to pay attention to. I'm feeling less confident about these trend lines. I feel like every time I draw one, it's either broken or violated or changes in some way. So I'm just sort of keying in on the overall trajectory. We keep making higher highs. We've drawn down after that gap higher on Wednesday of last week, so we're trading lower in the days since that gap higher. That was on Thursday's session of last week, actually, after Wednesday's rally. So overall, we're not going up for the last couple of days, but we're still well above what I'd call the line in the sand, right? What's that level at which if you just set one price level on Stockcharts and said, hey, alert me when we hit this moment, and then I'll make sure I revisit things and rethink maybe a bullish position. For me, that level's 50-50. We remain well above that level, right? So we finished today just about 5,200. It's about 150 points above my line in the sand. The 50-day moving average is almost right at that level as well. So for now, conditions are strong, right? We're making higher highs, we're making higher lows. Although we're breaking some of these trend lines, we're still above a line in the sand. The momentum is strong but not excessive. So I'd have to define this market. And if I summarize it, the conditions are good. The trend is positive. And while I'm seeing warning signs like late day sell-offs, like bearish divergences, which we've highlighted, the price action is still making progress to the upside. So I think overall that's more encouraging than not. Through the remainder of our market recap, let's look at some individual names. Over the weekend, I was looking at some individual stocks with a few moments, and just wanted to highlight some of the names moving today as I was reviewing some names earlier in the afternoon. Western Digital, Seagate Technologies, STX are two. Think of them as the hard drive companies. Western Dig bouncing higher today, up almost 5%. It did come off going into the close. Most stocks did, to be honest with you. It was sort of a broad sell-off just in the last hour of trading. But the damage done on the upside with a nice move. And what I like about that move is that takes us to a new swing high. And again, that's where, forget about the noise of one individual day. Literally take a step back and just think about the overall trajectory. And if you're not good at visualizing that, we have an indicator called zigzag, which automates that. And it says, all right, if you have a certain X% move, make it a new zig or zag, sort of connect the highs and lows. But I find visually it's actually very easy to do so. And most recently, we made a new swing high around 66. We pulled back and found a swing low around 58, just above the 50-day moving average. Now we're rotating back to the upside. We're overbought again, but that doesn't concern me a ton. It just tells me that overall we're in a pretty good uptrend. And this is the most impressive thing about a chart like Western Digital. For the last almost 12 months now, to be honest with you, the relative strength line has been steadily improving, particularly in the last couple months. So year to date, Western Digital has outperformed, and a day like today is just the latest move in that uptrend. Here's Seagate Technologies. You can see they're similar. These charts rhyme, but they're certainly not the same. STX is actually well below big round number resistance around 100. The last time Seagate tested 100, you had this really gnarly bearish engulfing pattern, which is a 2-bar candle pattern. We have an up day and a down day, and day 2 engulfs the range of day 1. That told you we're at a short-term resistance. We found a double bottom support, and now we're back to retest resistance at 100. I think Seagate above 100 is a really constructive chart because it would do what Western Digital just did and break to a new swing high. I feel like I have to acknowledge when a food products company, which is a weak group in a weak sector, this is in consumer staples, which has been a pretty rough sector, particularly on a relative basis. When a name like this is getting it done, I feel like we have to give some credit where it's due. MKC, which is McCormick, up over 10% today. Now this gap higher and then the higher move through the course of the day takes us just above $77 a share. That's up over 10% from Monday's close. It also gets us back above the 200-day moving average for the first time since August. This does get us above the overbought threshold of 70, but again, look back at this sort of move. This is why a gap above the 200-day and we become overbought is usually not a bad thing. That actually often becomes the beginning of further traction to the upside. There's another 3 months of upside movement after that overbought condition and a gap above the 200-day. I'm seeing a similar kind of setup now, which is what it tells me to sort of, other evidence, if I see contrary evidence, I'd change it. But until then, I think a chart like this is innocent until proven guilty. Maybe there's a recovery in some of these previously lagging food products names. Shout out to Tatiana, one of our producers of the show, who pointed this one out to me, Krispy Kreme in the news, ticker DNUT. This used to trade a while ago, by the way. If you look at a weekly chart of Krispy Kreme, and if you've been doing this a while, you might remember it used to be public under a different ticker, KKD. It actually was taken private and then re-IPO'd here in 2021, so sort of an after the COVID era restructuring and a release, but gapping higher almost 40%, and they sort of had been doing some tests with McDonald's, and now it looks like it's going to be a much broader rollout of Krispy Kreme donuts in McDonald's stores. Obviously, they're ramping up production to sort of match this expected demand. If a donut burger comes out, I'm going to try it. I'm going to have to tell you. But overall, the market taking this as a big sign of a thumbs up for Krispy Kreme. The upside potential of this sort of broad distribution is certainly there. Again, markets are a forward-looking mechanism. So I would say with the gap higher today, which is a reaction to the news, look tomorrow to see if there's additional buying and additional upside momentum in a name like this. But certainly from a fundamental perspective, gives you a different frame of reference for what the upside for Krispy Kreme could be. Another name in this same sector, consumer discretionary, is Bath and Body Works. Obviously, a bit of a different business, but up about 2.5% today. And again, what's refreshing to me is we have our guest in a few moments here, Mary Ellen McGonagle. She's going to share some stocks in the industrial sector, a little more value-oriented names. But what's interesting to me is as I'm looking for stocks making new swing highs, sort of in that nice uptrend above two upward sloping moving averages, I'm finding quite a few of them. BBWI is Bath and Body Works, again, really close to making a new swing high here. So I like the bounce today, but I'd love to see it get above 45, which would take us, really 46, I'd say, to take us above the February and March highs. But all that does is continue, just like Western Digital, just sort of continues that trajectory of uptrend, higher highs, higher lows. And I think you're seeing that there as well. Keeping this happy food thing happening, Domino's Pizza also gapping higher today. Not really much of a gap, actually. We overlapped a bit from Monday's trading, but up almost 4% today. And this does take us to a new 52-week high, just above $480 a share. And again, when I see a move like this and people point out, well, it's overbought, so you probably want to hold off. I don't know about that. I mean, as a short-term tactical play, maybe. And the signal really isn't when it becomes overbought. It's when it comes out of that overbought region, right? A lot of times things will gap and move higher and become overbought on that initial move, on that breakout move. You want to look, the dangerous sign is when it comes out of that overbought region, because that means whatever momentum was taking us higher is now dissipating. You're not seeing that here. Today, we're actually gapping, we're pushing higher with an RSI just below 78. But overall, I think it's a strong chart, making higher lows. So this stock above 440 is a pretty good chart. That's about 9% below current levels, but overall, the 50-day and recent support well below current levels, making higher highs and higher lows. FDX is FedEx Corp, also making a new 52-week closing high today. And what I like about this is we're gapping above 280. We then pulled back to that breakout level from December of last year. Today, sort of resuming that uptrend. So a gap higher, a bit of a pullback on Monday. We closed at the highs yesterday. We continue that upward trajectory. So I like the short-term sentiment sort of matching the gap higher. Compare that chart to UPS, and you can see why comparative analysis is so meaningful. These are two stocks with similar models, obviously different companies, but in a similar space. One of those breaking higher and testing resistance, one of these below a downward trending 200-day moving average. Ask yourself, as an investor, which one of these names would you probably want to own and why? If you answered this one, I would review some of the basic concepts of trend following because, as Paul Tudor Jones said, nothing good happens below the 200-day moving average. That's it for our market recap, and a lot of charts to tell you about, a lot of things to think about. It's a shortened holiday week with the Good Friday holiday on Friday, so no trading for bonds, and also the stock market is closed as well, so we have a shorter week. But through the next couple days, we do have some economic data to think about. A number of companies reporting earnings, including a cruise line, I think, on Wednesday. That's Carnival. But overall, the trend, I would say, innocent until proven guilty. Before we bring on today's guest, Mary Ellen McGonagle, just one reminder. We're going to do a mailbag episode for that Good Friday holiday, and we would love to answer one of your questions on the air. You can get your questions to us via email, thefinalbar@stockcharts.com. We're on the X, @FinalBarSCTV as our handle there, so just tag us in a comment. And here on YouTube, drop a comment below the video you're watching. We'd love to hear from you. Hope to answer one of your questions in our next mailbag episode. I want to welcome on today's guest, Mary Ellen McGonagle. Mary Ellen is the president of MEM Investment Research, coming to us from Southern California. Mary Ellen, great to see you again. How are you doing these days, okay?
Oh, very well. Thank you. Yes. Enjoying the sunshine before a lengthy rainy weekend out here in LA, but can't complain.
I'm heard the sunshine is quite lovely. We haven't had a lot of it in this area, although we did have a very sunny day on Sunday, so that was nice. Having said that, the markets, obviously not a lot of clouds in the markets. The overall conditions appear to be strong, but you find yourself, as we're winding down Q1, feeling confident about the position we're in, yes or no, and why?
Yeah, great question. So we've had a wonderful Q1 as far as returns, broader market returns, more specific if you got those stocks right relative to AI related and growth we're seeing elsewhere, you're in good standing. We are ending the quarter a bit overbought. And so I am suggesting entering new positions lightly. I want to see that pullback, that beautiful November breakout after that period of consolidation would be ideal at some point. So have already picked the horses, the winners, and am adding very selectively to the new buy list for my MEM Edge report.
It's amazing. I mean, I feel like more and more areas of the market, you've seen breadth conditions improve as it feel like more parts of the market have started to participate. You brought a couple names with you, all in one particular sector. I'd love for you to walk through these and just why are you highlighting these names now? What's the attraction of these? We'll start with Eaton Corp, I think, right? ETN.
Yeah, so what we are looking at are stocks that are in the industrial sector. It's one of several cyclical areas that have come to life and are continuing to outperform. And a lot of that has to do with the Federal Reserve. Last week, they did finally come out yet again and state that they are on track for 3 interest rate cuts this year. That is a wonderful backdrop for these cyclical areas, industrials being one of them, financials, discretionary. And so with that, we have that behind us, although we do have a key inflation data number due on Friday, which may wobble the cart a bit. But at the end of the day, a declining rate drop, and then also the fact that we are seeing growth within the economy.
It's amazing, right? And I think with industrials in particular, I mean, if you look, it's not just one group. I feel like a number of groups have started to show strength. I know Grayson Rose and I were talking. We've looked at things like building materials and other names have seemed to do quite well. Let's look through the 3 of these in particular. Talk us through the charts. And, again, the backdrop is good, but the charts are good too. I think that's what's so interesting here, right?
You're right. Yeah. So when I'm looking at cyclical and other areas, I am going to keep that growth backdrop that's really important for me and for my work. So the names I'm sharing with you are going to have certainly 2 of them AI related biases that will help them continue to grow. So Eaton Corp, ETN, is one of those names I'm highlighting there with that arrow. That was when we added it to our MEM Edge report in response to strong earnings. But there's a lot here as far as how the company is providing electrical infrastructure for these AI data centers, a very key component of all of this data crunching that's taking place amid this adoption of AI, and they're a key player. Its stock remains in a nice confirmed uptrend above those key shorter-term moving averages with positive RSI and MACD. I remain bullish on this name.
And a Northeast Ohio company, so I have to shout out to the Cleveland area, Eaton Corp. I'm interested with this one in particular, Marianne. When you have a name like this, I think the challenge, I feel like you had mentioned it before in your introductory comments. Is so many names like this have had a run so much. I mean, when you see Eaton like this, how do you think about the potential reward of a further upside versus just the fact there's this delayed pullback that it feels like may come at some point? How do you manage those sort of 2 sides of this?
Great question. There's 2 things that you can do. One is take a look at historical precedent. We can go back to May of last year. We had a similar base breakout. And if you look at the advance out of that base breakout, it was 4 months. So at this point in time, we had that base breakout in the beginning of February. So we're 2 months in. That's one way. The other is to take a look at a longer term chart. A monthly chart will provide you that insight relative to, again, precedents and where we are. That's going to give you a good view to really give you information for your longer term investment outlook.
Yeah, I have the weekly chart here, and it's amazing. I mean, some of these names, the run that they've had. But again, I've learned from working with the O'Neill methodology, which I know you're intimately familiar with. I learned not to be afraid to buy new highs because new highs tend to fuel further new highs down the road. FTAI, same sector, we're still in industrials. Talk us through this one in particular, if you could.
Yeah, this is a smaller cap name. I did add it last week on that base breakout, and a lot of this company's activity has to do with aftermarket parts. They also have a portfolio of aircraft that they lease. But going to that manufacturing side, there are issues that are taking place universally amid aircraft manufacturing, call it Boeing. And this company has been able to come in and fill in some of those gaps. So we are seeing this base breakout that took place due to a market upgrade, and analysts raised their target And if the price were to go to that, it would be 60% above the current price.
Wow. So a consistent uptrend, but further upside perspective, or I guess, or perspective with analyst upgrades down the road. Sterling
Mhm.
Infrastructure, STRL is the third name. Same sector. What's the idea here?
Yeah, so this particular company is also going to be involved in areas of growth. They do turnkey solutions for data centers. So that's a big area, of course, now with AI. They also do a lot by way of housing, providing the cement bases for these new home constructions, and that's a very strong growth area. And then infrastructure. They are very involved in providing not only materials, but also project management for these infrastructure moves. So, and that is another big growth area.
It's so interesting. I mean, as you're talking through these names, it's hard to deny the fact that these uptrends seem very consistent. They keep making new swing highs. You mentioned in the introduction just sort of, the, I guess, things that are potentially hanging over this market, right? A change in spike of inflation, for example. How do you, I guess, I mean, is this given the environment that's uncertain, given the Fed that we have a sense of its trajectory, but we don't know? How does that inform your decisions now? I mean, do you buy breakouts because they're good breakouts, or do you tap the brakes on adding positions because of some macro perspective? Connect the macro and micro for us in your process.
Yeah, that actually, when I am looking at stocks now, for instance, if on Friday we get a strong inflation number and we get comments from Fed Chair Powell that may pull these names back,
Hmm.
I am a buyer on those pullbacks because the general overview and the broader market is constructive. Now, of course, I will pay attention to valuation and the fact that these names, some of them are stretched, and that really has made it difficult to find new names in this market. But if you have that understanding that the backdrop remains quite strong, you will have that confidence to be able to add to positions on any pullbacks.
It's interesting. The environment certainly seems like it's has been very good for stocks. We've seen a lot of good breakouts. Anytime I've looked for stocks making new highs versus new lows, there are a lot more stocks going up than going down right now. To put it mildly, what are sort of the warning signs you would look for from a technical perspective? Is there a certain, is it names that have been working like an Eaton Corp start to break down? Is it more of a macro, the QQQ, which have been such a leadership area of the market, starts to struggle? Or is it something more macro, something like interest rates? What would tell you, uh-oh, I need to start getting more defensive? Is there a red flag that you would be looking for here?
Yeah, so I'm all about looking at those charts, Davis. I know you are as well. I'm keeping an eye on that weekly SPX.
Hmm.
If we see that RSI get up above 80, it's not something that you see that often, and it will present a very light red flag as far as being on the lookout for, at the very least, a period of pause. And then from there, if we do see deterioration and selling, it's going to be all about the volume characteristics. We are seeing distribution days,
Hmm.
particularly in the NASDAQ, that is concerning at this point in time. And then converting back to that daily chart and paying attention to those shorter term moving averages. If we begin to break support, first that 10-day, then that 21-day, and then also marrying that with that RSI, that's going to be key as far as knowing whether the broader markets are going to pull back.
I mean, for now, I would say it seems like the evidence seems firmly in the positive side. The Nasdaq, the S&P continuing to make new highs. Thanks for giving us some ideas along the way here. Again, it's refreshing that you can come on and share stocks that are just starting to break out of these bases yet again. So thanks so much, Mary Ellen. Good to see you.
You
Thanks for
bet.
bringing some names with us, and we'll look
Yeah,
forward to seeing you again soon.
good to see you too.
That's Mary Ellen McGonagle. Mary's the president of MEM Investment Research, highlighting three stocks in a sector that I would 100% agree. We've talked about how some of these growth names have had extended runs. Some of those growth leadership names have started to hit the pause button. Things like Apple come to mind, coming off of their attempts to make new highs. Areas of the market like industrials, like even basic materials, at times energy, some of those other areas of the market that you may not have been thinking about certainly can be some interesting opportunities. Not necessarily tech growth names you'd know, but charts that really deserve your attention. Really appreciate Mary Ellen McGonagle pointing out some of those actionable ideas right about now. Folks, we got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. So IBM, I think, is a representative of a number of growth-oriented stocks. And today, Mary Ellen McGonagle, I think, made the case for things like industrials quite well. And similar to what we saw with some of the charts in our market recap, uptrends are to be assumed to be in place until proven otherwise. As I like to say, innocent until proven guilty. One of the signs of prospective guilt, I would say, would be when we move higher on weaker momentum. And a shout out to the folks down at College Station, Texas. I spoke with one of the classes at the Mays Business School earlier today via Zoom and had a discussion about bearish momentum divergences when price moves higher on weaker price momentum. We looked at the example of the QQQ, which has a similar pattern, but today I want to highlight IBM, making higher highs January, February, March, weaker peaks in momentum. And remember, when the market is moving higher, usually we want to see stronger momentum, which means better up days than down days and sort of continued momentum building to the upside. You're not seeing that on some of these names that have been some of the best performers over the last 6 months. IBM made new highs in March with the RSI not even getting quite into that overbought region. That's after being overbought on the January peak. So higher highs on weaker momentum is a red flag. That's the first item on my bull market top checklist. So there are a lot of other things that we've not checked off yet, but we are checking off that first one. I would be wary and be looking for signs of distribution on some of those, the leading names showing divergences. Now, chart number 2, I think answers the question, but if you're not going to own stocks, where do you go? And I certainly don't think it's in bonds, at least not yet. This is a long-term chart, a daily chart going back for the last 3 years, looking at a simple ratio of stocks versus bonds. And I'm using ETFs for this, the SPY divided by the TLT, just a simple ratio of the one versus the other. So this is a friendly reminder that during 2001, a bullish phase for stocks, during 2002, which was a relatively bearish phase for stocks, 2003, 23, the uptrend phase, the downtrend phase, going into the October low, coming out of the October low. Generally speaking, with some brief movements to the contrary, overall, it's been stocks over bonds in a pretty big way. And I think the bond markets have a lot to prove before it feels like that is a better opportunity over the medium term, long term for your portfolio than stocks. And again, this ratio is not a judgment call. This is just observing the relative performance of these two. It's been stocks over bonds for quite some time. And I think there's a lot of change we might need to see. In general, you want to stick with what's working versus things that are not. This ratio tells you it's still stocks over bonds until proven otherwise. Finally, in our market recap, we highlighted some of those names breaking out and breaking down. It was interesting that in the exact same group, sort of delivery services type of names, you have FedEx making a new 52-week closing high. You have UPS not making a new 52-week closing low, but certainly not having a particularly strong day as it's moving higher. Now, think about with these types of charts, this is a really good opportunity to use our gallery view where you can compare two charts to one another. This is a great argument for using just the normal chart list feature and just putting stocks into orders based on their scooter ranking or based on percent moves or where they are relative to their moving averages. All those things are possible on the Stockcharts platform, and it'll help you differentiate from a name like FedEx, which I would argue fairly constructive, gapping higher, finding support at previous resistance, versus UPS, which has demonstrated a number of times its inability to get above a downward sloping 200-day moving average. In general, I have learned if you want to outperform the markets, you want to be in things that are not going down, but things that are going up. So make sure that your normal process of chart review focuses more on the names working versus the ones that are not. Folks, that's a wrap for the show. I want to thank you so much for joining us here for the final bar today after the close. Special thank you to Mary Ellen McGonagle of MEM Investment Research coming to us from Southern California. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.